We'll have the pleasure to continue having Praveen with us in the next roundtable panel discussion, where we have four distinguished panelists, and also we have the immense pleasure to have as moderator Théodore Economou. So Théodore is also the co-organizer of this conference. Théodore, it's always a pleasure collaborating with you. Thank you very much for all your efforts. Théodore is a very seasoned professional, C-class executive professional, as you say. He has held a number of C-class positions. He has been the CEO formerly of Lombard ODA Investors. He's serving in the investment committee of the Virginia Retirement System, one of the biggest pensions in the world. And has held numerous other positions. We're going to consume the time if I'm about stating all of this. So Théodore, the floor is now yours. Look forward to a very lively panel discussion. Thank you very much again.
Thank you very much, George. It's a pleasure to be here and to have these very distinguished panelists with me to close this terrific conference. To the audience, you've probably noticed that the edge of this conference is bringing together practitioners and academics. And together with that, we also aim to give you insights that you won't get anywhere else. And so this is exactly the recipe we'll follow for this panel, touching on topics that are timely, that are relevant, perhaps a bit controversial as well. But again, hang in there because you are going to hear some terrific advice from our all-star lineup of panelists. Praveen doesn't need introduction. He's been beautifully introduced. I would only add that he's been a key driver of UTI's global growth over the past 16 years. And today he oversees offices in 3 continents. So for this panel, he's going to provide us with an irreplaceable perspective on India, not only, but by extension, a global view of what is happening, especially outside what we tend to call the West. So welcome, Praveen, to this panel. Then I welcome Umberto Tamburrino, who's CEO and CIO of Sosteneo. Sosteneo is a major actor in infrastructure investments. It's part of the giant Generali Group that we all know, with more than 600 billion in assets. Umberto has, I would say, lived and breathed energy investments for 3 decades. He brings a really unique perspective because he's been both CEO of operating companies and an infrastructure banker. And so he really can tell us about private assets from all aspects. I'd like to welcome Umberto and share one impressive detail. He was a Fulbright scholar, which is probably the most exclusive scholarship program in the world. Then we have Georgios Dairis, who's Deputy CEO of Piraeus Asset Management. If I had to describe George, I would say he's an investor's investor. He's been managing investments for 3 decades. He's managed assets in all the major asset classes. He's an accomplished professional. But in line with this seminar profile, he also has a very strong academic credentials, backed by a PhD. And so therefore, we're lucky to have George to give us an allocator perspective that brings together the professional aspect, but also the formality and discipline of an academic. So welcome, George.
Hi.
And finally, Christos Bossolis, who's investment director at Alpha Asset Management based in Athens. Alpha manages 6 billion, and Christos' expertise has led many of Alpha's strategies to, I think we can say, consistently rank among the top in Greece. And Alpha, perhaps it's linked, manages the largest UCITS funds in Greece. Importantly, it's a global multi-asset strategy that directly benefits from Christos' expertise in asset allocation. And part of the success comes from the fact that Christos, throughout his career, has had a consistent focus on innovation, which is very much today's theme. So I know he's itching to share views on crypto, on AI, and all the other innovations going on in our industry. So welcome, Christos.
Thank you, Théodore. Thanks for having me.
As I was preparing this panel, we went through some prepared questions. But of course, I have to recognize that this week is a historic week. It is the inauguration of Donald Trump 2 days ago. And so we have to start with that. And I will start by, asking Praveen from his vantage point in Singapore and Dubai in Asia, what does the Trump presidency change for you for investments outside the Western world?
Thank you. Thank you, Théodore. Always a pleasure to speak with you and my fellow panelists. That's a very complex question. We live in a globalized world, which means there is a complex web of interdependency and interconnectedness between countries. So therefore, there is no straightforward cause and effect to Trump policies. I bet even Trump doesn't know what he's going to do tomorrow. But from what he's said until now, tariffs will increase on all US imports. And there's a sort of two-order impacts. One is on China and how it impacts India. Chinese exports will slow down. It'll have an impact on Chinese GDP. So we can expect China to have some headwinds in their economy. That's one. Global companies will try and de-risk from China and move their supply chains elsewhere. So countries like Mexico, Vietnam, India will gain. Trump has also named Vietnam as a problem case of high surpluses. Therefore, we think India will stand to gain in a few specific areas like electronics exports, textile exports, pharmaceutical exports. So there are some areas where India will gain for the simple reason that Chinese cost of labor is 2 to 3 times greater than the Indian cost of labor. So India has that distinct advantage, which will crystallize into India's exports rising. So that's first order. Second order impact, I think, which is more worrisome for me, is that the impact of Trump's tariffs will be on the American consumer. Prices of imported goods will rise. That will lead to inflation, which means the Fed will have to fight a bigger challenge of inflation. And instead of cutting rates, by the end of 2025, I suspect we will see the Fed increasing interest rates, which in an already indebted America will create a havoc. Middle America, at the bottom of the pyramid, is struggling. Businesses are struggling. Bankruptcies are at a 14-year high. And that will completely change the value of America, the dollar. So I expect a turnaround, a troublesome turnaround in geopolitics by end of the year, simply because of inflation and interest rate impact.
Thank you, Praveen. We're starting with a controversial view, so I love it already. Let me one more question on Trump impact. Clearly, his priority is changing the energy policy. Umberto, you're an energy man. What will this do to the world? Drill, baby, drill is what we heard 2 days ago.
Yes, thanks, Théodore, and good afternoon, everybody, and thanks for the invite. I think we should put things in context. Let me give you another piece of controversial view, if you want. America is part of the global growth in energy projects. We know that the world is going in a certain direction. If you look at data from 2024, America accounts only for less than 10% of the global capex spent worldwide. And I'm afraid, I agree with Praveen, this figure would just go lower than that. Why is that? Because first of all, Praveen said that very clearly, inflationary measures will unfortunately increase interest rates and will increase price of imported equipment for the country. So you have a very nasty combination of higher cost of capital and increased capex, which is a killer for new projects, okay? So things will slow down over there. If I were in charge of a global infrastructure fund, I will not bet on US as my next destination for capital projects, okay? And in fact, Sosteneo is not investing in the US. We're investing mostly in Europe and Asia Pacific. So this is my view on energy projects.
Well noted. So we have two bookends here. We heard from Nikolaos Panagiotou on the one hand that plentiful liquidity will continue to drive the US markets from a technical standpoint. At the other end, we are hearing that fundamentals could really come into question, which is clearly not the market consensus right now. Let me turn to the two allocators in our panel. Georgios, where do you stand and how does this impact your allocation as you look at 2025?
Well, good afternoon, everybody. The main drive for us comes from the previous speaker, which is Praveen, which provides us with a hedging alternative. For us allocators, the main thing is to have options and alternatives. And India right now seems to be a hedging risk against China and whatever happens to the relationship with US. If tariffs were raised, we agree also that we will see inflation rising, but the business model of India provides us with some hedging. And I'm glad that the presentation of Praveen just confirmed our view that the India model based on consumption will be more stable in the coming months, will provide some alternative for all the, let's say, emerging market exposure that is seeking to diversify from the Chinese problems or till Chinese problems are solved. So for us, it's nice to have an alternative, and we'll wait to see where all these debate settles, because we agree with the previous speakers that inflation will rise. We may see impacts on currencies that will be affected in an effort to absorb the cost of tariffs. But in any way, we'll have some challenges that I don't think the market is pricing right now.
So if I hear you, this might be the time for not emerging markets, a term that doesn't really mean anything, but for some countries in what is called the emerging markets. Christos, geopolitics to the fore. We start with geopolitics. What are your views?
Yeah, first of all, good afternoon, everybody. And again, thanks for inviting me, Théodore. So let me start with a brief comment about the Trump presidency. And I think that although there are many uncertainties, especially considering Trump's pre-election statements, I would expect that, as in his previous term, we may see a wide divergence between statements, between proposals and actual policies. I think Trump he's considered pro-business and market-friendly, at least for the US market, and he often indexed his success by the pace of economic growth and by the level of the US equity market. Obviously, especially for the rest of the world, as previous speaker said, Trump's tariff policies are by far the largest source of uncertainty across his agenda. So yes, we may see increased volatility as he threatens to impose tariffs to other countries, but I would not expect sizable and across the board the tariffs, but let's say more moderate and targeted ones. Now, from a geopolitical point of view, I think Trump election may allow for a reset in many conflict zones. We may see new diplomatic efforts and de-escalation, for instance, in Ukraine. So it is possible that, at least in the first year of his administration, we may even see a global de-risking from that point of view. Now, having said that, it seems that the US tariffs and the broader trends of deglobalization and onshoring reflect a strategic shift in the US economic policy. And while the immediate rationale for tariffs was framed as addressing unfair trade practices, intellectual property theft, or trade imbalances, I think the underlying strategy seems to be part of a broader effort to contain China's rise. and also maintain US technological leadership. So, and I think the continuation of many of these policies under the Biden administration suggests that this is more than a temporary trend. Now, as a broader comment regarding geopolitical risk and its impact on markets, I would point that historically, geopolitical tensions have always existed in the background, sometimes having a stronger influence, other times a more subdued one. However, post World War II, we have seen that the market's reaction to geopolitical events has typically been brief. I mean, the impact often plays out over the course of days or weeks, and before the market shifts to its focus back to fundamentals. And unless these events cause a broader structural change, they usually create a buying opportunity for investors. And again, as history shows, the subsequent 1 year or 3 year returns for a 60-40 portfolio following major political shocks have been positive. Most of the times. There are only a few exceptions in the 1 year period. And on average, the 60-40 portfolio returns are close to 10% in the 1 year after a geopolitical shock and above 20% in the subsequent 3 years.
Thank you, Christos. A lot of good advice on what perspective to put the Trump presidency in and how to position. With this, let me close this parenthesis with which we started on Trump and move to the heart of the matter here, which is really the challenges for allocators today. We heard a lot about innovation throughout the different sessions today in different areas, private markets, AI, crypto, emerging markets, i.e. India, and so forth. I'd like to go back before we go deeper into discussing the pros and cons of these innovations. From an allocator perspective, what is the problem we're trying to solve today? What is the biggest problem you're dealing with? Let me turn to Georgios and then I'll go back to Christos. Georgios, what is the biggest problem as an allocator, multi-asset that you're dealing with? So that we can put into perspective then some of the tools that were presented.
Well, Théodore, it's not a matter of problem. It's a matter of, let's say, phase. We're moving into a phase where stock selection or asset selection or country selection will play a major role. I think momentum has run, or the momentum strategy has given us a lot. And I think this year, next year will be, 2025 will be a year of selection, a year of choices, because the risk premia are returning to normal. So there's a discussion of what is normal. And this is what the markets will price. If the normal will be the, let's say, the average of the last 10 years or the average of the last 20 years. So this will be the name of the game for 2025, in my opinion.
And the real challenge, Christos, do you agree? Is the largest issue the end of momentum strategy, or are there other issues that are in your top of mind for you?
Yeah, obviously there are a lot of issues, problems, or I might call them challenges. And one of these challenges, which many participants are highlighting today, I agree, is US equity market concentration. The cumulative weight of the top 10 stocks in the S&P 500 stands today at about 37%, relative to about 17-18% 10 years ago, and an average of about 20% since the 80s. And these same 10 stocks also account for more than 25% of the MSCI World Index. And this topic, I think, is also related to the discussion about valuations, since in the US, it is these stocks that drive this high concentration that seems to be relatively more expensive. So regarding the implications for future returns, I think that we have to make a distinction between the short run and the long run. There's no evidence suggesting high concentration leads to lower returns over the short term, say 1 or 2 years, as it is other factors such as near-term economic and earnings growth, flow sentiment that drive near-term returns. And the same stands for valuation. Equity valuations are not a good predictor for short-term forward returns. And on the other hand, there's a strong relationship between the starting P, let's say, of the S&P 500 with subsequent 10 years returns, so with long-term returns. So looking longer term, also there's no consensus whether there's a relationship between high concentration and subsequent long-term equity returns. In my opinion, it's very important to first understand the reasons for this high concentration. So looking at the US market today, one reason I think is obviously because the largest companies in the index are the most profitable. So index earnings have become more concentrated in the largest firms. And the second reason is that these same companies, these mega cap, mostly tech companies, they trade at higher valuations relative to the market. And this is driven by expectations of continued strong earnings growth and also persistently high margins. And okay, yes, to an extent, this is justified. They are quality companies with strong business models. They generate high free cash flows, and they also benefit from structural trends.
But let me cut you off, Christos. I think you know this. The question is, what do we do about this? What can an allocator do about this? So we heard from Georgios. Let's move away from indexing and from the benefits of momentum and go back to actually active management, such as we knew it, perhaps 20 years ago. What is the headline in your mind on what we should do?
Yeah,
what an allocator should do.
Okay, so just to be clear, I'm not saying that the US mega cap firms are necessarily in a valuation bubble. They may continue to do well, but it's just that there's a risk that if their growth rates slow, this will have a negative impact on their performance. And what I'm saying is that the problem may turn out that the returns for market cap weighted indices will likely be lower than average over the next decade. But the return of the average stock, which trades at a lower valuation today, may do better. So we have to be selective. We may consider looking at not market cap weighted indices, but maybe equal weighted indices, and look at other areas that in the market that seem more attractively valued. And also we may consider diversifying and looking at alternative asset classes in order to
we'll get to alternatives, but we'll get to alternatives. Let me pick on that point, which essentially you're arguing, we all as allocators have the shackles of the market weights that applies to within indices, but it applies to indices relative to each other, which typically has restricted in the last couple of years, reduced on a relative basis allocation to emerging markets as a whole. Praveen, what are your clients telling you? Are they willing to recognize some of the edge that comes from challenging index composition and overweighting, because that's what it is, India? And what are they, why, how do they justify this?
No, I agree with a lot of what Christos said. As allocators, the final refuge in the face of uncertainty is diversification. Diversify, diversify, diversify as much as you can by time frame, by asset class, by every possible manner of diversification, including currency. And a lot of our clients are expressing a grudging acceptance of the US dollar, because of the way the US dollar has been weaponized in the last few years with sanctions and tariffs. The sense that we need an alternative to the US dollar itself, not just the Mag 7 or the S&P, that has been an underlying trend. which is why you see a lot of bilateral trade across countries and diversification also into gold. The S&P for the last 1 year has given a return of 25%, while gold roughly 36%. And that tells you a story that the faith in US dollar is not as good as it was, let's say, 5 years ago.
So let me ask you this, because this is really a gold nugget that you're sharing with us, no pun intended. What you are telling us is that in your part of the world, I mean, Greater Asia, going from Dubai to Singapore, you are seeing gold being recognized and included as a bona fides asset class in portfolios. Because as you know, this is not the case in typical institutional portfolios in the West, neither in Europe nor in North America. Is this what you're seeing?
Yes, it is.
Yes?
It is becoming a significant, and simply because the confidence comes from who are the main buyers of gold, the central banks across the global south and Russia. Russia, China, India, and across the GCC, there's been a tremendous amount of gold buying, and it's relentless. It's not stopping because the faith in US dollar, I wouldn't say it's crumbling. It is backed by the might of US military, but it is not as good as it used to be. And given the rising debt, the American debt problem and the Buffett indicator, the ratio of American market cap to American GDP for the first time crossed 200%. So we are in risky, uncharted territory. Therefore, diversification, whether it's private markets, whether it's gold, it's AI, even crypto, all of these things are on the table, and they weren't on the table even 2 years ago.
So we are touching now on challenging a lot of the accepted wisdom, right? We heard from Georgios to move to selection, move away from indices. We've heard from Christos, challenge the concentration. We're hearing from you, add gold as a new asset class. Perhaps crypto will come into that as well. Let me turn to Umberto, private assets. We heard Edward tell us, look, the source of return of private assets will change, but the case is still there. Probably the last innovation, the most recent innovation with private equity and private debt has been infra. Tell us about infra. What does it still have a space? Is it something that allocators should look at expanding their footprint on, and if so, how?
Definitely expand, because if you look at the numbers, allocation towards infra, especially infra equity, is pretty quite low across the board. Now, if you look at the main.
But is it smart? Is it smart? That's what we want to know.
Well, listen, I think there is an opportunity there because sometimes you have this magic planet alignment, which I think is the case today. Why? Because there's a very strong demand, especially in my space, which is energy. You have a global demand for new capex in the region of 2 trillion per year for the next 20 years. It's a lot of money. A GDP of a country like France is less than that, and every year. And that means that a lot of projects just requesting capital. And on the other end, you have people that love this kind of products, which is very interesting in terms of risk-adjusted profile, because effectively, especially if you go what we do, which is greenfield projects, for the benefit of everybody, greenfield are the new projects, the new capex, not the one that have an impact because they substitute older projects, especially in talk fossils versus renewables or ancillary infrastructures like networks, like storage, But the good thing about those projects is that if you enter early enough in the value chain, so at the construction state, you still have a very nice double-digit return with very low volatility. And why is that? Because you hedge in advance each and every variable in the business plan. You have long-term contracts for the sale of capacity, if it's BESS or battery storage, or electricity, if it's a power purchase agreement for production. You hedge the cost, you hedge the cost of the debt that you enter when you do the construction of that facility. So interest rate, even exchange rate in some cases. So you try to lower so much the volatility, which gives a very nice yield effect in the years of the business plan. So the bulk of the return of the IRR of the projects is given by distribution as opposed to the final sale of the project as you do in private equity. You know, with your private equity, effectively you try to buy cheap to develop something and to sell it. But guess what? This is becoming a bit out of fashion these days because first exits are more difficult. And second, you don't distribute anything in the years of the when you have the whole period. And some investors, some LPs are starting to be tired that they don't get anything. Why? First, because they don't de-risk. The more you distribute in the course of the business plan, the more you're de-risking your entire return, you know? Because 60-70% is given of distributions and just the 30% is allocated to exit. Whereas in private equity, you have 100% allocated to exit, okay? And second, because you see the impact of what you're doing, no? Because you can control how the asset is going and then correct it eventually.
So this sounds almost too good to be true.
That's right.
Risks?
Where is the trick? The trick is choosing well what you're doing, what you're building. It's not a mystery that there are stranded assets all over the places because you have not selected the right location, because you don't have the right counterparty you do your business with. But one thing is certain, if you do the right choice, which unfortunately comes just with experience, okay? So it's just experience that can tell you, I can teach you how to select a good project. But one thing is certain, the need for this capital-intensive project is higher and higher. As you heard, AI does not come for free. If you need to build a data center, it will come only if and only if there is a dedicated power plant attached to it, which I mean off-grid, not connected to the grid. The grid is not able to satisfy the demand that's requested by data centers. So if really the world is going that direction, unfortunately, that has to come with new capital project attached to that. So I'm trying to give you some long-term trends that will help in selecting.
Let's cut to the meat of it directly. Which types of projects wouldn't you do today because there's too much money flowing into them or not enough drivers?
Okay, so first of all, as I told you, the important thing is to invest on project rather than on companies. And I touch this point each and every time. Sometimes companies are, and especially developers, the platforms, they sell what we call pipe dreams instead of pipelines, okay? And this is unfortunately not a good way to invest your money because you make a bet on what they're going to deliver over time, but it's either 100 or 0. And guess what? Sometimes it's 0. So you can lose your money. Second, okay, so this is my inclination. Be happy with the 15% return. Don't shoot for the 20-25% of private equity, but at least the 15 is very solid.
It sounds very attractive.
But the second advice, I can give you some more advice. You need to select also well the technologies where you're investing. In my sector, I don't want to talk about roads or social infrastructure, but in energy, there is a clear priority of what you're going to invest every day. At the moment, the system does not need much more generation. People think about building solar and wind to replace fossil. Unfortunately, the grid is not equipped to host that amount of intermittent power. So what you're going to do, you're going to spend the money in the right things, which is battery storage and grid upgrades, which is the right way to improve the system and to make the system fit for additional generation capacity to be injected in the system.
Very helpful. Before we move to a couple questions, a couple of questions from the I'm looking at the questions of the audience. China, we have a question here contrasting valuations in China versus valuations in India. Praveen, how should I can imagine what your answer is, but please in 30 seconds.
When something is cheap, it's probably cheap for a reason. And China is cheap, it's very attractive. PE multiples of 8 versus India is about 21. Yes, if you want long-term compounding of returns, India is a better solution. China is unpredictable because you never know when the Chinese government can turn off the fickle investment engine.
Very clear. What about the rupee exchange rate risk? Bank of India, I think deputy CEO is in Davos these days, and he was on Bloomberg this morning talking about it.
Yes. So India, the rupee on average has depreciated over the last 15, 20 years, about 2.5% per annum. And yet it is one of the safest, most stable across all emerging currencies. I mean, if you look at the euro, the sterling, the Japanese yen, and I'm not even going to talk about the Turkish lira or the Brazilian real, the rupee by far is one of the most stable. So if you're getting a return in Indian equities of about 15 to 17%, you lose 2% on currency, that's all right.
Noted. Let me move to our allocators now. You heard a pitch on private assets during the session. You heard more from Umberto with I think, truly fantastic insights on avoiding some sectors, which is kind of advice you only really get at this event, unbiased and direct from deeply experienced professionals. Do you, Christos, Georgios, do you include private assets for your clients? And if so, what are the trends? Georgios.
Well, Theodore, well, I'm happy to share with you that we are in a fortunate moment where we do have European Union legislation and directives that introduce us to a new wrapper, the LTIFs, that will permit us to include projects like infrastructure or private equity or more stuff like Umberto described in a popular format that clients can access and understand. So probably we will see more of that in the coming days.
Thank you. Christos.
Yeah, I think George covered the topic. I mean, we have some institutional clients that have expressed interest in private markets and more specifically in private equity, and they have make some investments, but these are a few clients, to be honest.
Noted. What about crypto? Do you have clients that are interested in crypto? Will you include crypto in one of your funds? You have one of the leading multi-asset funds in Greece, the leading multi-asset funds in Greece.
Well, to be honest, I would be very careful as far as cryptos are concerned, especially for investors like pension funds that are, at least here in Greece, more conservative and of a balanced risk profile. And from an asset allocation perspective, I think one has to examine, among other things, when it comes to cryptos, whether they increase a portfolio's expected return or lower its risk, and either due to low risk of its own or due to their low correlation with other assets. Now, if we focus on let's say the Bitcoin, which is the first and largest cryptocurrency by market capitalization, we can see that its volatility is extremely high, both in absolute terms and relative to other asset classes. Therefore, even a very small allocation of, let's say, 5% in a 60-40 portfolio will drive portfolio volatility disproportionately higher. So that's one thing. Now, turning to correlations, we can see that its correlation with other asset classes is very unstable. As we saw during the COVID crisis and in 2022, Bitcoin became very correlated with the S&P 500. And more recently, its correlation with the S&P 500 has again picked up materially. So it seems that Bitcoin is closely linked to broad liquidity trends and the risk on risk of flows, which makes it less of a diversifier, in my opinion. And it makes it more of a leveraged beta exposure.
Very clear perspective from an allocator. Thank you. We have to slowly wrap up. We tried to touch on most of the topics that were presented today during our session, but I'm reminded that we're coming to the end and that we have to wrap up. I'd like to go around and ask each of you for one piece of advice. What should be the top priority for allocators today? What is your number one advice? Praveen.
Diversify into growth and country specific.
So move away from the index, diversify, more than implied. Excellent. Umberto.
Well, I'm definitely biased, so I can say. Now, my general belief that allocation in private asset, and especially infra, is pretty low. If you look
Equity
at
or debt? Equity, right?
equity,
You're pitching for equity. 15% per year. You think is doable in this
it's a
environment?
good risk-adjusted
Return. You certainly caught the audience's attention here, I believe. George, closing piece of advice.
Well, I will stick to the previous speakers, diversification, and I will move one step further. I will say equal weighting. Just avoid the heavy bets.
And if I heard you, you add also to that selection, back to selection, just as we knew it, right?
Yes.
Great. Christos?
Yeah, for me, I mean, the key drivers of success for asset allocators and asset managers will remain just as relevant in the next decade as they have been in the past. So for me, it's important to follow a structured, disciplined, and dynamic investment process, aim to achieve higher risk-adjusted returns over the long term, have a long-term perspective, with a particular emphasis on fundamental analysis, portfolio diversification, and effective risk management. And one more thing, we live in a world of accelerated change and complexity with new technologies that can disrupt entire businesses. I think in the next decade, asset allocators who will embrace and capitalize on these technologies will have a clear advantage.
So I hear you. AI. AI is what the word I hear.
Yeah.
You didn't say, but that's what I hear.
Data analytics, AI,
Integrate
and
data
yeah,
analytics and AI
exactly.
to solve the allocator's challenge. Terrific. Well, with these precious pieces of advice, we close a panel that's offered, I find, timely, relevant, and controversial advice, which is truly what allocators look for. I want to warmly thank our panelists, and I will turn back to George. George, over to you.
Thank you, Théodore, and thanks to all the panelists. I think this has been a fantastic panel, and has overall, I think this conference has brought up the diversity of opinions. That's the aim of this conference. We try in a way also to be provocative and challenge some common beliefs. So we heard some diverse opinions, for instance, of private assets, on cryptos, and also on AI. So for instance, Claudia Guagliano from the ESMA perspective documented that AI doesn't add to the performance of fund managers, at least from the sample they considered. And even more strikingly, despite the narrative being used nowadays, there is only a small portion of EU funds which are currently using AI, and actually the flows to these funds is quite small. So I'm sure over 2025, many more interesting trends and patterns are going to come up. So for instance, we heard from Nikos Panigirzoglou that in his opinion, liquidity is going to continue driving the rise in the US stock market. And Edward van Gelderen also mentioned that some private assets at least are quite overlapping with public assets. So again, this brings up a number of issues to think about. I think we have reached the end of our conference, and I'm sure we have all learned something new today. That's the purpose of this unique conference. It's not just about recycling common beliefs, but also bringing new dimensions and making us all think more. I would like once again to thank our sponsors, our platinum sponsor, UTI International, our gold sponsors, Alpha Asset Management, Iolcus Investments, and Piraeus Asset Management, and our silver sponsors, Alpha Trust and Systemic. Our supporters, the Hellenic Fund, Asset Management Association, CFA Society, and the University of Piraeus Research Center, and our media partners, Banking News, Business Daily, Euro Today, Next Deal. I should also thank our speakers, high quality and very distinguished speakers. I'm also indebted to the conference co-organizer and dear friend, Théodore Economou. And last but not least, I would like to warmly thank the IFFR team for their support. And of course, you all for spending your morning or your afternoon or your evening, depending on where you reside, to attend this conference. As I said at the very beginning, more than 600 delegates have registered from 39 countries and from more than 300 companies. So we're glad we're contributing to this discussion and debate in asset management. This has been the 5th consecutive year. May I also remind you that IFFR is running a number of other conferences and seminars. In particular, we have a thematic series on ESG where we're collaborating with EBRD. Please stay tuned to find out more. We have also recently inaugurated a membership charter. You can find out more on the IFFR website. You can register for free to the membership list so that you hear first about our activities and enjoy various benefits depending on the type of event. With that said, may I say goodbye to all of you, a happy new year, and we're looking forward to seeing you again soon. Please fill in the questionnaire. Your feedback is very valuable to us. Once again, many thanks, and looking forward to seeing you all soon. Bye-bye.